The United States stock markets are officially closed today, Friday, July 3, 2026, in observance of the Independence Day holiday weekend, meaning regular live trading on the New York Stock Exchange and Nasdaq is paused until Monday morning. Looking back at the final regular trading session on Thursday, July 2, 2026, Zhongchao Inc., trading under the ticker symbol ZCMD, finished the standard session at exactly $1.11 per share, which marked a minor intraday downward move of 0.89%, though the real story broke loose in the extended post-market hours, where speculative volume drove the asset as high as $6.03 before it eventually leveled off around $3.44. When you see a micro-cap medical information stock exhibit this type of extreme after-hours volatility, the immediate market expectation is that we are looking at a classic retail-driven momentum pump or a standard short squeeze that will evaporate by the next opening bell. The underlying reality is far more complex and points to a company undergoing massive corporate restructuring to survive on major exchanges, having just completed a dramatic 1-for-3 share consolidation at the end of June 2026, which followed an earlier 1-for-8 reverse split in March of this same year. Investors logging into their Robinhood app or checking their active watch lists often get blinded by the massive percentage gains flashing on their screens. But if you look past the immediate numbers, you find a company desperately engineering its share price to fight off a Nasdaq delisting notice. This contrast between the outward appearance of a massive breakout and the inward reality of regulatory survival creates a unique scenario for active traders who enjoy high-risk environments. Most market participants approach small equities with the same mindset they use when buying mainstream assets like Tesla stock, Apple stock, or Nvidia stock, expecting that long-term commercial fundamentals will eventually drive predictable valuation growth. With a microcap Chinese medical technology firm, that expectation is often completely detached from reality because the stock price is dictated by equity dilution, capital compliance rules, and institutional restructuring rather than simple quarterly revenue beats. When retail accounts on an interactive brokers platform or a SoFi trading platform pile into a stock like this during an after-hours spike, they are usually chasing raw momentum without realizing that management recently priced a $5 million public offering at just $0.54 per unit. The market narrative says this stock is breaking out due to fresh interest in online investment circles, but the financial reality tells us that the float has been heavily manipulated by consecutive reverse splits designed to lift the share price above the mandatory $1 minimum listing threshold. Understanding how to navigate these situations requires moving away from traditional investment help philosophies and looking closely at the mechanics of microcap supply and demand. Trading volume for this asset exploded during the recent sessions, with tens of millions of shares changing hands as investors using various investing sites sought out high-velocity plays before the long holiday weekend. This massive surge in turnover shows that short-term traders are actively weaponizing the low float created by the recent corporate actions, buying up shares through their individual brokerage accounts and triggering automated momentum algorithms. While someone managing a conservative long-term portfolio through Schwab Intelligent Portfolios or traditional Fidelity investments might view this asset as radioactive, active speculators look at these daily swings as prime opportunities for rapid capital deployment. The tension here lies in the fact that while the company's operational footprint remains small and localized within the Chinese medical education sector, its equity behavior is global, erratic, and highly sensitive to sudden capital injections. Let us look deeper into the recent market movements, institutional positioning, and macro pressures that are shaping this equity. The company has faced severe downward pressure over the past year, with its trailing performance showing a massive decline that forced the board of directors to approve emergency measures. When a stock undergoes two separate consolidations within a 4-month span, it signals that the original share structure was severely diluted, likely due to continuous capital raises and public offerings that flooded the market with cheap paper. For instance, the public offering in late May of 2026 offered over 9 million units, each containing a share and a warrant, which naturally created a heavy ceiling of future selling pressure as those warrant holders look to cash out during any significant upward move. If you're practicing self-investing or setting up specialized portfolios through a Fidelity brokerage or a SoFi Invest account, recognizing these structural overhangs is vital because they explain why rapid price spikes are frequently met with aggressive institutional selling. At this point in our analysis, it is essential to look at what the business actually does underneath all the financial engineering and stock splits. Founded as a platform-based internet technology company, the firm operates primarily through contractual arrangements with variable entities in China, with its main operational hub centered around Zhongchao Medical Technology in Shanghai. The business model revolves around providing online healthcare information, professional medical training, and educational services to healthcare professionals through its established platform known as MD MOOC. Additionally, they offer patient management services specializing in the fields of oncology and rare diseases through their Chongqing sub-platforms. The expectation from early backers was that digital medical education in a massive market would yield steady, high-margin software revenues that could be easily scaled. The reality, however, has been marked by escalating operational expenses, strict domestic regulatory oversight on data and healthcare, and a general difficulty in converting platform traffic into consistent institutional net income. When you evaluate this company alongside sector peers or look at how it compares to broader indices on a Fidelity mobile app or an Interactive Brokers trading setup, the stark divergence in fundamentals becomes obvious. Traditional healthcare platforms command premiums based on user retention and recurring corporate sponsorships, but this asset has been plagued by a net profit margin that dipped severely into negative territory during recent fiscal periods. For everyday investors who rely on online investing tools or seek comprehensive investment guidance, the lack of traditional analyst coverage and institutional ownership creates an information vacuum that is often filled by speculative retail chatter on social media sites. This lack of stability is why many long-term savers stick to diversified instruments like Fidelity ETFs, Fidelity mutual funds, or automated options like an intelligent portfolio, leaving microcaps to the absolute fringe of the trading community. Comment below how many shares of Zhongchao Inc. you currently hold, or if you prefer sticking to large-cap equities during volatile market periods. Hearing from active traders helps us map out exactly where retail sentiment is flowing, especially when major names are taking a back seat during federal holidays. Looking forward into the upcoming quarters, the outlook for this entity is tied directly to whether it can leverage the cash raised from its $5 million offering to stabilize its domestic operations and avoid another drop below the $1 line. The capital market catalysts are clear. Management must demonstrate that the post-consolidation share structure can attract sustainable institutional investment rather than relying on brief after-hour spikes to maintain exchange compliance. The risk of further equity dilution remains incredibly high as microcap technology firms frequently return to the public markets for additional funding when operational cash burn outpaces revenues. If you're managing your capital through Fidelity IRAs, a Robinhood stock trading account, or looking at long-term asset allocation, the reality of this stock is that it operates as a short-term trading vehicle rather than a core foundational asset. As we wrap up this deep dive, the contrast between investor expectation and market reality remains the definitive framework for understanding this corporate trajectory. The market expectation frames the massive post-market movement as the dawn of a significant turnaround, driven by new momentum and technical breakouts on active trading platforms. The structural reality tells us that the asset is recovering from extreme dilution, navigating complex regulatory minimums, and relying on consecutive reverse splits to keep its place on the Nasdaq exchange. While the underlying medical education platform continues to serve its niche within oncology and patient management, the stock itself requires extreme caution, disciplined risk management, and a clear understanding of microcap mechanics. Whether you track these movements through advanced interactive brokers' fee structures, a simple Robinhood app interface, or dedicated Fidelity wealth management tools, keeping your eyes on the structural reality will always protect your capital far better than chasing temporary momentum. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.